Hey, good afternoon, everyone. My name is Jeanmonod, Regional VP Sales here at Angel Oak Mortgage Solutions. Today, we're going to be talking to one of our vendors, an appraisal management company, Kairos, sorry about that. And we'll get started here in about another minute. We'll let everyone log in, and then I'll introduce our subject matter experts and panelists. And this is being recorded. We will get this out to you before end of day tomorrow. And if there's any questions we don't answer here today, we will make sure that our subject matter experts get those answers for you, but no later than tomorrow. So give it about another minute, let people log in. Hopefully everyone's having a great May, and happy Mother's Day out there to all the moms out there, whether you're a mom on this call or you're married to a mom or you have a mom. So we'll give it about another 30 seconds here. People still logging in. All right. All right, let's get started here. Again, my name is Jeanmonod, Regional VP of Sales here at Angel Oak Mortgage Solutions. Yes, we usually do deep dive into our products, but today we're partnered with one of our partners, and we're going to talk about challenging a bad appraisal. So with me today, Ben Scribner, who's a regional sales manager in the Northeast. Ben, introduce yourself, please.
Hi, everybody. As John mentioned, my name is Ben Scribner. I'm a regional here at Angel Oak Mortgage Solutions for going on almost 6 years. The biggest reason why I'm on here is actually before my time at Angel Oak. I spent the better part of a decade in the AMC space, so I'm almost the internal sales guru for appraisals for Angel Oak. So I still can, always wrapped into challenges and understanding appraisals. A lot of the times those questions, still come to me for parts of the company, but I'm really excited for the conversation today. This is a big part of our business, and obviously in the circumstances we're in, more important than ever of how to work with appraisers and how to overcome and challenge perceived issues or legitimate challenges. But thanks, John. I appreciate you having me on.
Yeah, Ben, and thank you for handling all the calls from all the A's across the country when it comes to appraisal. So you're definitely a great resource. So, and also we have Gerry Allard on here from Kairos. So Gerry, please introduce yourself.
Yeah, hi. My name's Gerry Allard. I'm the Chief Appraiser for Kairos, and I'll be hosting the conversation here about reconsiderations of value and how to create an effective reconsideration when you've got a situation that demands it.
Yeah. And also Alex Todak. Alex, please introduce yourself.
Hey everybody, I'm Alex. I'm one of the owners of Kairos Appraisal Services, and I'm here to support in any way I can. So thanks again for having us today.
Yeah, thanks for joining us. So before we let Gerry take us through the presentation, we're going to launch a quick poll question. And the poll question is, have you submitted an ROV challenge on a property value in the past 12 months? And I just want to share some stats with everyone. Home ownership, obviously it's the fastest way to accumulate wealth in this country. And values have, across the country, values have gone up since 2019 throughout the country. Certain markets probably more, and some 48.7% since 2019. So as everyone's voting, so let's just see what we have going on here. Okay, wow, 63% have submitted an ROV challenge in the last 12 months compared to 37% have not. So Gerry, let's take it away. That's good intel.
Okay. Well, I think I'll start with a moment of levity here. So there's two appraisers standing on a street corner, and they notice a sinkhole in the road in front of them. And so, of course, they have to figure out how deep the sinkhole is. So they look around, and one of them sees an anvil off the side of the road, So he walks over, picks up the anvil, drags it on over to the sinkhole, drops it into the sinkhole. Next thing you know, there's this goat racing down the street as fast as it can run, dives into the sinkhole. While these guys are scratching their head, a farmer comes by and he says, "Hey, have you guys seen my goat?" And they said, "Yeah, we saw your goat race down the road and jump into the sinkhole." The farmer says, "That's impossible. I had him tied to an anvil."
I promise you this will be informative. I didn't know it was going to be entertaining. So listen.
Okay. So from there, we'll dig into.
Before you get started, any questions you guys are going to ask, please answer through our question queue. Ben and I are going to be monitoring that. And again, this is being recorded. We will get this out to you before end of day tomorrow. Go ahead, Gerry. Sorry.
Okay, so what we're going to be talking about here today is how to prepare a reconsideration of value for a lender. So, you know, you've all run into a situation, you've got a home that's listed for $600,000, it sells for $600,000, and then the appraisal comes in at $575,000. And so then you have to figure out what can we do about this. And there is something you can do about it, and there's actually quite a bit can be done to to rectify the situation and to at least take a shot at maybe getting some resolution. I want to start by saying that appraising is not an exact science as much as, people oftentimes try to put us into that category. It's in order to be a good appraiser, it requires creativity, it requires, flexibility. If it were an exact science, then the AVMs, would get it right every time. And there would really be no need for appraisers. But Zillow, which is probably the most sophisticated algorithm, by their own admission, states that they are within a 5% accuracy 40% of the time, and within 20% accuracy 80% of the time. And that's not very reassuring, because that means that if a property is worth $1 million, they're saying that their range is within 80, their range is within 20%, 80% of the time. That means that their range could be anywhere from 800,000 to 1.2 million. So AVMs, are not the best indicator of value. And because it's not an exact science, there are different kinds of perceptions that people have about appraising. Let me see if I can get this working here. Down. There we go. All right, so everyone has their own perspective on what their home is worth, and everyone has a vested interest in the outcome of a purchase and sale of property. The lender wants, they want the most conservative value for security for a loan. The homeowner wants to get the most out of their house. The buyer wants to pay the least for the house. The tax assessor wants to get their money so they want the house to be worth as much as it can be worth. And the appraiser is supposed to be the one neutral party in this transaction that has no vested interest in the outcome of the value. And so in theory, the appraiser is the one entity or the one party that can come to the table with the most objective information and the most objective perspective on the value of the property. One of the problems is that homes don't always sell for the same amount. The same home doesn't always sell for the same amount. You can have two almost identical properties, and we see this all the time, where one sells for a little bit less, one sells for a little bit more. There may be all kinds of extenuating circumstances as to why. In one case, the agent might list it a little high, and somebody comes in and they love the home, so they just pay whatever's being asked for it. And maybe somebody else, they're wanting to get out of town quick, so they price their home competitively. It sells for less. So the appraiser has to look at identical properties with different value ranges and then determine what the value of the subject is, which would be similar to those properties. Now, everything in the appraisal industry is geared toward making creating a value that is the lowest value in the range. Because there's always a range of values. And agents, everybody else would like to see properties valued at the highest end of a value range. Appraisers tend to value toward the lower end of the value range. The reason being that all of the GSEs and all of the focus of Fannie Mae and others lenders for challenging an appraiser are based on overvaluations. Fannie Mae has collateral underwriting scores, and those scores are always geared toward challenging an appraiser who pushes a value up higher rather than an appraiser who goes lower. So appraisers oftentimes, and in my opinion, this is somewhat lazy, but appraisers will oftentimes go toward the lower end of the value range because they're less likely to be challenged. You're almost never challenged if you take so if you've got two homes, like in this scenario where one sells for $795, one for $815, the appraiser could put the value at either of those numbers. But most appraisers are going to put it toward the lower number because they know they're not going to get challenged. They put it toward the higher number, somebody's going to come along and say, hey, why didn't you consider this property which sold for less? They will almost never come back and say, why didn't you consider this property that sold for more? So this is a major problem, in my opinion, in the appraisal industry. And it's one of the reasons why oftentimes appraisers do come in low on values, and there is then more of an open door to come back and challenge that appraisal. USPAP, which is the Uniform Standards of Professional Appraisal Practice, is the guidepost that all appraisers have to adhere to. The rules in USPAP are the rules that all appraisers must conform with. And so all of the data that's in the USPAP handbooks is information that appraisers have to be aware of and have to conform to. And one of the FAQs in USPAP, again, it's Uniform Standards of Professional Appraisal Practice, states that the contract sale price can be a good indicator of the property's market value, and it may be logical and reasonable for the appraiser to conclude that they are the same. So, it is reasonable to assume that the contract price is a reasonable indicator of the property's value. However, the contract price also must not become a target of an appraisal assignment. So the challenge that we run into now, this is the biggest challenge that we're seeing today, is that so many homes are escalating in value from what they're listed for, and oftentimes it's just simply not the data to support where a purchase price ends up landing. So if and realistically, most agents will price a home where they believe it should be valued, and then if people come along and there's multiple offers and it escalates considerably above the amount that it was listed for, there should be a general recognition that it may not appraise for the value that's being purchased for, because in that case they're really going beyond where all the data allows the appraiser to go with the value. And some of that just has to be recognized. I think, I see a lot of purchase and sale of contracts, and the agents that I think are the wisest or the most experienced will oftentimes recognize they've looked at the comparable data. They know what's out there for sales that are available to an appraiser. And so oftentimes, they will structure a contract to compensate for that. So either there'll be there'll be no financing contingency in the appraisal. They'll put a certain amount down, maybe 50,000, 100,000, whatever the escalation was. That will be compensated for to cover for a low appraisal. So they'll say that the buyer will pay an additional 100,000, to address a low appraisal. Those are just smart things to do. Where we run into the greatest challenges is when a home escalates significantly above its list price. There really are no sales to support that, and the agents have brought in a buyer that won't qualify unless the appraisal comes in at the sale price, and all that does is create animosity and anger and frustration with everybody in the process, because the appraiser has to work with closed sales that are in the marketplace, and they can't operate off of pending sales. They can't operate off of active listings. Agents will often go, well, hey, everybody's now listing these homes up higher, but for an appraiser has to work off of closed sales. So they can't use active listings or pending sales to determine a value. They have to use closed sales. You know, and sometimes, again, just being creative as a real estate agent or as a loan officer, if you're working with agents, you know, sometimes even a simple thing like there may be a couple pending sales that would support the sale price, and those pending sales will be closing in the next week or so, and you know might wait to have the appraiser go out to your subject property until you've got one or two of those that have closed, so they have more current data to enable them then to bring the value of that property up a little bit higher. But it's something that, in my opinion, you know, agents, loan officers, everybody involved in these transactions has to be constantly aware of and use wisdom in making the decision about how you're going to proceed forward. Because everybody loses when the appraiser cannot value the property at a sale price, and that's the only way for the transaction to actually go through.
Hey,
So
Gerry,
thinking ahead about and planning for that is incredibly helpful.
Gerry, got a question here from Derek. You know, are realtors allowed to be at the inspection?
Yes, absolutely. And I highly recommend to real estate agents that when you're not sure that the value of the property is going to be there, and especially if you have comparable data that you can use, I would recommend meeting the appraiser at the site, or at least emailing them the data that you have, because you got to fight for your transaction. And you know, this AIR FAQ that's in front of you, the appraiser independence regulations from the Dodd-Frank bill, you know, state that appraisers can talk with real estate agents, and real estate agents obviously have a lot to offer. And I've talked to agents who have told me that appraisers have said to them, well, I can't talk to you, you know, because I can't be influenced, which frankly, that's a sort of a side issue, but I think that's a bit of a cop-out in the first place, because nobody can be influenced unless they allow themselves to be influenced. However, some appraisers don't want to talk to anybody because of that concern. But the FAQ and the appraiser independence regulations do state that appraisers can talk to real estate agents, and there is no reason for there to be any resistance to doing that. So if you have data, you know, you think is good data for your property, it's much better to get that in front of the appraiser before he completes the report, he or she completes the report, than have to deal with it in ROV later.
And Gerry, I know we're going to get to a lot of intel, but I did want to, Cedric brought up a good comment, Ben has kind of answered this. When you make an appeal, you make an appeal to the AMC, who agreed on the appraisal in the first place. Why would they change their mind? It's like being on trial, make an appeal, being judged by the same judge. And I know we're gonna address some of those concerns there, Gerry, and how what you guys do, maybe what's a little different from other AMCs. So Cedric, I know you had a question in the queue, so I just wanted to acknowledge it, and we'll hopefully get some answers there. So go ahead, Gerry. Yeah. Sorry about that.
No problem. Thank you. Yeah, and we will touch base, you know, on that. So I wanted to quickly touch on, there we go, on the ANSI requirements, because this has come up multiple times here recently. ANSI standards are a new standard that appraisers are required to adhere to when they're doing their measuring and how they present the footage in an appraisal report. So the ANSI is the American National Standards Institute, and they have certain regulations and requirements, and all appraisers have to abide by these. And sometimes it makes an appraisal report look a little, you know, strange. And so I'm going to give you just a couple of insights into how ANSI works, so that you'll be able to understand this when you see it in an appraisal report. You can see in this photo in front of you that there's two homes here that are split level houses. The one on the left, you can kind of tell here that all of the footage is above grade. But what above grade means is that there is no portion of the home that is below ground. And in ANSI standards, if it's even 6 inches below ground, it has to be counted as basement footage. But if it's not 6 inches above ground, if it's all above ground, then it has to be counted as all above grade footage. So even though you have two split levels here, the one on the right, you can see there's a portion of the rec room in the basement on the right side of the home, as you're looking at the photo, that is underground. And you can tell by the yard itself going up a little bit. So there's a portion of that's below grade. So that means that the appraiser has to count all the footage on that lower level as below grade. And in the grid, in an appraisal report, that goes into a different place than where the above grade footage goes. So you have these two split level homes. The one on the left is going to show 1,600 square feet, 3 bedroom, 3 baths, all on the same line in the appraisal grid. On the other home, it's going to show 1,230 square feet, 3 bedrooms and 2 baths. And then down below that will be the below grade footage, which will be 600 square feet with 0 bedrooms and 1 bath. So in the end, you have very similar size homes with similar bed and bath count, but they're going to look very different on an appraisal report. And we get calls all the time where people don't understand this and they say, you know, what's going on here? This is crazy. You know, my home has, you're only giving me 1,230 square feet, you know, credit for my home when it's got 1,600 or 1,800 square feet. And what's going on here? And it's just because they don't understand how to read the report. And as an appraiser, it is a little frustrating sometimes to have to lay it out this way because it's really not how the marketplace relates to it, but it's what we're required to do by the ANSI standards. The other thing with the ANSI standards that is can be very confusing is when you have like a 1.5 story home and the half story up above, it does not have 7-foot ceilings. It cannot be counted as livable footage. This is true of the basement. A basement that is lower than 7-foot ceilings cannot be counted as above grade footage. So in an upper level, the way ANSI works is that 50% of the floor area, and you can only count from 5 feet. So if your slope goes down to 3 feet, you can only count the amount of it that's 5 feet tall. And then from there, 50% of that footage has to be above 7 feet. And if it's not, then you cannot count that footage in the appraisal grid as above grade footage. It has to go down as a separate line item at the bottom of the report. So again, this is very confusing for people. It was very confusing for appraisers when these regulations first came out, you know, figuring this stuff out, figuring out how to match comps to the data from the subject property. But when you see these things, at least you'll have some idea of, you know, why it looks the way it does on a report. And this is all the requirements of the ANSI standards. So again, 50% of the floor area has to have a minimum of 7-foot ceiling height, or it cannot be counted as above grade footage. So, or livable footage. So in the end, you know, again, you have a house, it's a 1.5 story house, you have 2,000 square feet, but 600 of that is above, you know, on the upper level. So then now you're only going to show 1,400 square feet in the grid. And everybody flips out about that because they know that they're supposed to be 2,000 square feet. Where's the other 600 square feet? Well, that 600 square feet is going to be down at the bottom of the grid in a separate line item and approached individually. So when you see that, you'll know exactly, you know, why that is. Hopefully, I haven't made it more confusing, but
no, but it's great.
Yeah,
it's great. I'm learning, so it helps me. So
okay. Good, I appreciate that. So we're going to look a little bit at how to kind of make a case for this, and this is essentially when you look at an appraisal report, you got 15 pages on an appraisal report, but the key places you want to look is in the grid. There's usually going to be 2 pages of grids, and the grid will be your comparable sales. So like on the first page of an appraisal report, what consists on that page is all the data about the subject property. So on the first page of the report, you'll have the site size, you'll have the contract, of course, contract information, you'll have information about the neighborhood, you'll have a breakdown of all the components inside the house, like the floor coverings, whether tile, vinyl, hardwood. You'll have a breakdown of the bedrooms, the baths, you know, all that kind of stuff will be on the first page of the report. And it'll all be just sort of detailed out. And then that information is transferred over to this page, the grid page, which we call the grid pages. The grid pages are the most important pages of the report for you to be aware of and to kind of understand, because that's where the heart and soul of the appraisal report, you know, lies. And on the left-hand side here, this is all the information from page 1 of the appraisal report summarized in the grid. And so on the left side, you'll have the summarization of the characteristics or components of the subject property. And then to the right, you'll have your 3 comparable sales. And oftentimes you'll have another page with additional comparables. And there you'll have the characteristics of those properties to compare to the subject. And in an appraisal report, everything is compared to the subject. In other words, all the comparables are adjusted to become more like the subject. Because there are always going to be these differences, and so you can try to compensate for those differences to bring together the characteristics so that these comparables line up to be similar to the subject. And in this, the one that you're seeing here on screen, there are a couple things to keep in mind. There's like basically a 20%. It's not a rule, but it's a guideline. 20% guideline is for things like the site size, the age, and the square footage. So typically, appraisers are going to try to stay within a 20% range of their site size, 20% range of their age, 20% range of their square footage. Can't always be done, so you'll oftentimes have to break out of those boundaries, but those are the ideal boundaries. And so if you can kind of keep that in mind, that 20% is the ideal to stay within a 20% range on those items. You'll also notice here that things like the design, the subject is a rambler, it's a 1-story. All the comparables are 1-stories. And typically appraisers are going to use the same design and style if at all possible. I oftentimes see ROVs sent over and the designs of the comparables that are sent over are different from the subject. Now, if the appraiser uses all 1-story rambler designs for their comparables, then that's what you have to use if you're going to challenge the appraisal. Because if you throw in a 1-over basement or a 2-story or a tri-level, some other design, the appraiser is just going to say, look, this is a rambler, all the comps are ramblers. I'm not going to divert to a different design when there are ramblers available to compare to. So when you're putting together an ROV, those are things you have to keep in mind. You have to match the characteristics of the appraisal report. There are things that can be argued if the appraiser is wrong. Like there's things like quality of construction. Those are all identified in the appraisal report. They are defined in the appraisal report as to what a Q4, for example, is, what a Q3 is. That's a quality rating. The condition rating is a C rating for condition. If the quality rating is Q4, that's an average construction quality. Now, if you can see from county records that one of the comparables is rated differently than the subject, you could make a case that the appraiser maybe missed what should have been a quality adjustment. Things like that can be brought up. But essentially, your goal, if you're going to put together a reconsideration of value, is to match the characteristics that the appraiser uses in the report as much as you possibly can. And you'll see in this example, if you look at the very top, it has the proximity to the subject. And all 3 of these comps are within 1 mile of the subject property. So if that's the case, then you want to make sure that when you're looking for comparables to present to the appraiser to challenge their value, you want to make sure you stay within the same boundaries that appraiser used. So if the appraiser didn't go over 1 mile and you have a comparable that's 3 miles away, I mean, I just ran into this yesterday where reconsideration of value was sent over on a report. I was looking it over, and the appraiser had all the comps within 1 mile in a very defined area, and the comps that the person put together for the ROV were all in where Interstate 5 is. They were all on the other side of Interstate 5, over 2 miles away. So it's just like not understanding that the appraiser kept everything within the contained neighborhood of the subject, and now you want to throw comparables out there that are completely outside that area. So you want to look at where the appraiser has lined up their data and match that data as best you can. So if the appraiser didn't go over 1 mile for their comparables, then you're looking for comps that are going to be within 1 mile. If the date of sale, if all the comps that the appraiser used were within 3 months or 6 months of the date of inspection, then you want to try to keep your comps within 3 to 6 months. So you have to pay attention to that if you're going to put together a good reconsideration of value for an appraiser to look at. You can also see from here that the sale price range on this property is between 535, up here, the middle comparable, the low price is 535, the highest price is 600,000. So you've got a range between 535 and 600 of sale prices here. The goal of an appraisal report is to adjust the comparables so that they become more like the subject. So the end result of that should be that the adjusted sale prices after the adjustments are made should be a tighter range than the range of the sale prices. So you've got a $65,000 range of sale prices here. And if we go down to the bottom of this report to see where the adjusted sale prices are, they should be within 60, should be closer than 65,000. And
Hey, Gerry,
okay,
one question.
I guess we have these on here. So just real quickly here. So just so you can see at the very bottom, these are the adjusted sale prices, and they range from 555 to 586. So you've tightened up that $65,000 range down to a $30,000 range, and that's the goal of what an appraisal does. It adjusts the comparables so they become more like the subject, which brings those adjusted sale price of those comparables closer together. Okay, sorry, what was your question, John?
Travis is asking why, and you might not have this at your fingertips, but why is the third comp receiving a $15,000 adjustment for a C3 when the others are rated as C3 as well?
Yeah, great question. So the reason is because C3 is a very broad definition of condition. And within a C3 radius, so Fannie Mae states that you can have variable adjustment amounts with the same condition rating, because a condition rating is, it's been updated since original construction. There's been, at least some components that have been remodeled or updated. That would be a C3. Well, that's a very broad range. So anything that's been, so the next range up is C2. C2 is like new construction. C1 is new construction. C2 is like new construction. So something that's been gutted and completely renovated and remodeled might be a C2. C3 is everything from, they updated the floor coverings in the kitchen and bathroom to they remodeled the kitchen and bathroom and added new flooring and did new trim work and added new doors. I mean, there's a wide range that still fits within C3. So the appraiser has to make a determination of where the subject is and how many updates have been to the subject. They compare that to the updates of a comparable, and if the updates to the comparable are greater, then they're going to make a negative adjustment. If the upgrades of the comparable are less than the subject, you're going to make a positive adjustment. And so that $15,000 adjustment means that the components were updated to a superior degree for this comparable than they were for the subject. And obviously it wasn't too much better, or there would have been a higher adjustment. So the adjustment is the amount is reflective of the differences in the remodeling, quality of remodeling, the amount of remodeling that's been done in the home.
Cool. Thank you.
Okay, so with that, then the appraiser came to a value conclusion of $560,000. It is required that the appraiser bracket the adjusted sale price of the comparables. So the appraiser must place their value in between the numbers at the bottom of the grid. They don't have to be in between the sale prices, although that's ideal, but they must be within the range of the adjusted sale prices of the comparables. So the appraiser could literally, could place the value here anywhere from 556 to 585, and anywhere within that range would be acceptable because it brackets the adjusted sale price of the comparables. So the appraiser is supposed to put the value of that property where it's supposed to weight it toward the comparable that's the most similar. So if comp 3 was the most similar comparable, they'd want to weight it toward the 586. If comp 2 was the most similar overall, then they would weight it toward 555. So there's still a $30,000 range here to work with, and the appraiser can work within that range. It's theoretically, in theory, you would say, well, comp 2 well, actually, if you look down at the very bottom, you have the adjusted sale price, you have the net and gross adjustments. The net and gross adjustments tell you which property is most similar. In this case, all three of these are very similar. The gross adjustment on all three of these is, between 3.5% and 4%. That's a very low gross adjustment amount, and that means that they're all, fairly similar. So the way that net adjustments and gross adjustments work, if you look at comparable number 1, you've got a plus 9,000 for the bathroom, and that's because you have a half bath there on comp 1. Subject has two full baths. So the appraiser is making a $9,000 adjustment for the half bath. And then they're making another $900,000 adjustment for the square footage differences. Comp 1 is smaller, so it's adjusting for the square footage. So that's an $18,000 adjustment, which is all going one direction. It's all a positive adjustment. So your net adjustment is the same as your gross adjustment. If, for example, comp 1 square footage was 1,560 or 1,700 square feet, then it would be a negative adjustment. So if the comp 1 had more square footage as a subject, which required a negative adjustment, if it was negative 9,000, you would have a net adjustment of 0. You'd have a positive adjustment for the bath. You'd have a negative adjustment for the greater square footage. That would net out to 0. But your gross adjustment would still be 3.5, because gross adjustment is the total amount of adjustment made. The net adjustment is how many positives and negatives there are that offset each other to determine a net adjustment. I mean, ideally, a perfect scenario would be a 0 net adjustment, because maybe the comp has a larger site size, so that's adjusted one direction, and then has a smaller square footage, so that's adjusted the other direction, and they even each other out, and that becomes a net 0. So the guidelines have always been that net adjustments should not exceed 15%, and gross adjustments should not exceed 25%. And it's not a requirement, but it is the guideline that has been set and that lenders still adhere to. So again, just to put this into perspective, if you can bring in a comparable sale that would, based on the adjustments that the appraiser uses, would result in a lower net or gross adjustment, in theory, that's going to be a better comparable. So it's a way to kind of measure the comp that you might be bringing in. If you use the same adjustment analysis the appraiser used, so let's say the appraiser used $100 a square foot for their living area adjustment, then you apply that $100 square foot to the comp that you're bringing in, and then you can determine how similar it is to what's in the report.
So Gerry, a couple of questions that have come in that I kind of like. How do you adjust for high-end improvements versus, say, your local Home Depot quality improvements?
How do you judge that?
Yeah, how do you adjust, I guess, for that? I guess that's the question Nikki's asking here.
Oh. Well, I mean, that's a really good question, but it's very discretionary on the part of the appraiser. I mean, sometimes you can't really tell. But when I first started as an appraiser, I mean, we worked out of books that had pictures of houses and didn't have anything on an interior. So when you saw a comparable property, you had no real idea what it was like other than what the agent put down as comments. The upside right now is you can, agents provide multiple photos for pretty much every comparable property. So you can go in and you can see the quality of workmanship, you can see the quality of the kitchen cabinets and counters. Now, you're not always going to be able to tell, but you can make reasonable assumptions, and that's all that the appraiser is expected to do. It's all anybody's expected to do, make a reasonable assumption. If you can tell that.
Another question here from Renee would be, so would this value lean towards comp 3 adjusted value, or,
Well, I mean, ideally, that's what everybody who, that's what the agents, everybody else would want. They'd want it to be weighted toward the higher end of the value range. But appraisers will tend to go toward the lower end, because again, if you appraise this at 580, for example, which would be bracketed in the numbers, as an appraiser, you're more likely to get challenged by that, because some underwriter or reviewer is going to look at it and go, hey, wait a minute, you have two comps here that are in the 555 range and one in the 586. Why didn't you wait toward the bottom? Now, if you wait toward the bottom, they'll never come back and ask you why you didn't wait toward the higher end. But they oftentimes will question when you wait toward the higher end. They'll often question that. They'll never question when you wait toward the lower end. So appraisers have a tendency to wait toward the lower end of the value range. That is a real detriment. Something that, you know, appraisers, I mean, like me, have been fighting that for years. That it's a really unbalanced system when appraisers are only challenged when they kind of push the boundaries toward the higher end of a value range. So, you know, I mean, like I'll do that and I still train my appraisers to do it, but we oftentimes have to answer for that. So an appraiser who doesn't want to get bothered is just not going to do it, because they know that they can just move on and do the next report if they go low. They go high, there's a higher chance, higher risk that they're going to get challenged, and they're going to have to go in and answer for why they did it. Now, you can still be confident that you can answer for why you did it, but
Right.
you know, who wants to put the extra time in if you don't have to? And that's the way a lot of appraisers think.
You know, Gerry, what we're doing here
Hey.
today is, you know, obviously just educating and informing people. You may not like what you're hearing sometimes, but, you know, it's the fact, and I appreciate that, Gerry. One, Jeannie's asking a question here, and I know we've got about 20 minutes left here. Jeannie's asking a question here. We just had an appraisal that used 3 closed properties, 1 active, 1 pending. Is that okay? Thought you said you only had to use closed properties.
Yes, so the active and pendings that are placed in an appraisal report are placed in there strictly to support the value, or to sometimes show that the market is stable, or to show the market's increasing, or whatever it might be. They serve that purpose, but they cannot be used as just a requirement for the appraisal process. USAMP and Fannie Mae does not allow the appraiser to value the subject property based on where pending or active listings land. They must weight the value toward the closed sales. So in a way, appraisers are always behind the curve, because something that closed even a week ago might have gone under contract 2 months ago. And so it's not really current, but it's just the way the system is set up. And it's a safeguard, you know, for investors and for lenders to make sure they're always on the conservative end of things, particularly if the market's increasing. Whereas the market's declining, it could work opposite, but that doesn't happen too often. Usually it's the market increasing. So unfortunately, the appraisers cannot wait toward pending or active listings. So that's why I say, if you know a pending sale is going to close within a week, you might want to hold off and not get the appraiser out to the house until after that pending closes, so you can provide it to the appraiser and say, well, here's a closed sale, just closed yesterday, you know, and it's very similar to the subject, and it might, you know, wait toward a higher value.
And then the other question here is generally guidelines. How far back does an appraiser go for closed sales?
Well, okay, so appraisers can go back as far as they need to. So there's no rules that prevent an appraiser from going back even 2 years. However, the ideal is always the most recent sales. And so if there are recent sales, you can't ignore those to go back to older sales. But if there are no recent sales, then you can go back as far as you need to. There's been situations where we've had to go back 2 years to find any comps for certain, you know, unique properties. And when that's the case, then that's the case. You have to make your case as an appraiser for why you use the comparables that you used. But there's always going to be, the demand is always to use the most recent available sales.
And this might be just a one-off, Gerry. So where did it go? Also, extraordinary, David's asking, extraordinary lot size differences never are valued by an appraiser in the same degree. Just moved, hold on. I'm going to scroll back up here, excuse me. They never valued appraisers in the same degree and the market demand for them. How would you challenge that? So a unique lot size or a bigger lot size?
Yeah, there is. The thing that I always tell people is, you know, I would not focus my attention on challenging adjustments in an appraisal report, because it's very difficult to make any changes there. It's also very difficult to, you know, verify in a reasonable way that a different adjustment should be made. It's just opinion. You know, somebody can say, well, hey, I think this one's house is much nicer and you should have made a bigger adjustment. Well, that's an opinion. And so it's hard to get traction there. The traction really comes when you can find sales that are similar to your subject, and particularly if you can find sales that are more similar than what the appraiser used. and providing those to the appraiser. That's where you get the most bang for your buck. Challenging, and I've seen people write out pages of dissertation about things that they don't like about the appraisal report, and none of it is usable, because you can't go back to an appraiser and say, look, well, I don't like your adjustments. Unless you have evidence that you can provide that's really significant, supportable evidence, it's just opinion. And so there's no point in going there. It's just a waste of time.
Right.
Focus on good comps, providing good comps to the appraiser.
Yeah. Yeah, I know we only got about 15 minutes, Jerry. I know you're going to cover a lot, which probably going to answer some of these other questions here. So.
Yes. And this is just, I'm bringing this form in because it's a condo form, and condo form is set up a little bit differently than a single family residential. Essentially, just to understand how condos work, appraisers are required whenever possible to provide 2 comparable sales out of the subject project and 1 in a competing project. So there's always, weight is always going to, in a condo, weight's always going to go toward the sales in the subject project. So when you're looking at where the value of a condo is likely to come in, if there are sales in the project, that's where the appraiser is going to go. Even if there's a competing project a block away, which has higher sales, lenders, appraisers, everybody's still going to weight toward what's in the subject project. So again, you always want to keep that in mind, when you're trying to challenge a condo valuation. So I'm going to move down a little bit here. Okay, go ahead.
No, go ahead.
Again, okay, I'm going to touch on the short-term rental thing because that's something that we've been asked to address. Short-term rentals are a huge challenge, and short-term rentals can be placed on a 1007 form. It's, Fannie Mae did not design the single-family rent schedule to be used for short-term rentals, but it can be done. So, there's differing opinions about this, so you might hear different things from different people. Last year, we had the chief appraiser from Kairos Appraisal, a real estate attorney, and a representative from Fannie Mae all get on a webinar and talk about short-term rentals and can use the 1007 for short-term rentals. The chief appraiser for Kairos Appraisal said absolutely not, it should never be done. The Fannie Mae representative said, well, we really don't have a position on this, so we leave it up to the appraiser to make the decision. And the real estate attorney said, absolutely, you can do it. There's no reason you can't do it as long as it's done properly. So, the breakdown of a short-term rental situation is, number one, you have to have comparable data. So if you've got a short-term rental at Airbnb here in Seattle, for example, somewhere in one of the outlying neighborhoods of downtown Seattle, you are not going to find comparables because there's no management company or anybody that handles short-term rentals in areas like ours. Short-term rentals are typically most successful in areas that are destination areas. For example, in our case in Eastern Washington, there are destination areas where they do short-term rentals all summer long. A short-term rental would be identified by taking the gross yearly rent based on the seasonal activity of the properties, and then amortizing that over a 12-month period. So you'd still break it down to how much per month the property would bring in based on its yearly income. And then you would just structure the form that way and explain it in the form. So it can be done, but the challenge that we see, the biggest challenge, again, is that there's just not comparable data. So if somebody wanted a short-term rental done in Eastern Washington, for example, in these destination areas, there's lots of data available and it can be done on the 1007 form, no problem. So but in Seattle, outlying Seattle area, for example, if there's a short-term rental, typically we're going to still do long-term lease data in the comparable rent schedule because, number one, this is not a seasonal area, so you're not going to get that many days of renting an Airbnb, and so it's probably going to generate more income as a leased property on a month-to-month basis than it is on a daily basis for the rarity that it would be used. And secondly, there's just no sources to get information to find comparable data to match it to. So anytime you're looking at doing a short term, make sure that you know that it's an area where there is comparable data available. The best source that I'm aware of is AirDNA, which is a company that does provide short-term rental data all over the country. The problem is they don't give addresses. So you can't find addresses for the property. It makes it much more challenging to put together an analysis when you don't have addresses to work with. Still can be done, but it's just a lot more challenging. So all that to say that short-term rentals can be placed on the form, but there are a lot of limitations. And I would check out, check with an appraiser or with an appraisal management company. If you talk to us about a property that's in a short-term rental area, we can check with appraisers to see if there's data in that area or if they have to go with the leased properties.
Cool.
Okay, so yeah, I'm gonna go through all the detail of the report, but again, this is one that was done on a short-term rental, and the appraiser did a really good job with it. Laid out all the details and explained it all. So we are doing these, but again, there are limitations. So
Hey,
with
Gerry,
that,
Gerry, can I jump in there real quick? If somebody knows that they're looking
yes.
for a short-term rental, is that something you want them to communicate with Kairos ahead of time? Is that something, if they're looking for that short-term on a 1007, is that something that you would want that communicated up front? I'm just thinking, like you mentioned, get ahead of it, make sure those, anything you're anticipating, be ahead of it instead of saying, you get a completed report and you're like, wait a minute, I wanted short-term rental on this, and now you're kind of going back and having a challenge. Is that something that you would recommend for everyone listening?
Yes, absolutely. Because again, we can one come up the day, and I know the appraiser who knew the areas to talk to the appraiser. Then this has to be done term because the short rentals don't bring in as much money. I mean, people who do them, and they're doing it on certain weekends, their focus like that, but it's just not, and so they're going to get a lot of monthly leases. So it just set out the gate and to do something that really wasn't anyway. The reason ROVs are not typically not very successful, we have an approach that is unique, as the Kairos has.
Gerry, your audio Gerry, your audio's kind of cutting in and out a little bit right now. So I don't know if there's something we can do on that.
Oh, I'm cutting in and
Might
out.
be your connectivity. Yeah. So try it again. Just see.
Yeah. Okay. All right. So the reason that we have a high success rate is we contact the appraiser before we send me. What we do first of all.
Ben, are you not hearing it?
Sorry, you're breaking up for whatever reason.
Yeah, it looks like we're losing Gerry right now.
I'm not hearing you really clearly.
Yeah.
There you go.
Okay.
Yeah, I have no idea. Is that better? Okay.
Yeah, you're back.
So what we try to, when an ROV is sent to us, first of all, we look the ROV over. We have a couple people on staff here. We'll look them over, make sure that the data is good data to send to an appraiser. We don't want to waste the appraiser's time, because if we send an ROV to an appraiser that really is just going to get dismissed, then it just burns the appraiser out, and then the next time, they're less likely to take it seriously. So we want to vet the data first. You would be amazed how often people put the comps that are already in the report into their ROV. It happens way more often than you might think. So we will go back to the person who submitted the ROV and say, 2 of these comps are already in the appraisal report. So, can you take those 2 out, because we don't want to send these to the appraiser. And if you have another one to add in, fine. If you only have 1, we'll just send the 1. Once we have an ROV that we think has reasonable data in it, we'll send it to the appraiser. We'll always contact the appraiser in advance, and we'll let them know an ROV is coming over. And we just let them know that this is not an attack on them personally. This is somebody who's gone to the trouble to put together data that they would like the appraiser to take a look at. And we ask them if they could please just take a serious look at it. And if there's something that can be done with that data, we appreciate that, and we appreciate their time and their willingness to look it over. So we try to team up with them. And by doing that, we get much better results because appraisers are just people. And when you send them an ROV, they get defensive and they feel like somebody's attacking their work and saying that they didn't do a good job. So they start getting defensive right out the gate. So we try to break that defense down so that we can team with them, partner with them to try and see if there's anything that can be done. We've also seen appraisers, I think sometimes doing this, just as to be cantankerous or whatever. We've seen appraisers lower the value after an ROV. So, and I've seen people send data over in an ROV that would indicate that the appraised value is too high. So it doesn't really help if you want the value up and you're sending comps over that once they're adjusted are going to bring the value down. Then you're taking the risk that's going to come in even lower. So you have to be strategic about the data that you're providing and making sure that it's good data. And once we vet it, send it to the appraiser, get the appraiser, to kind of work with us in the process. Then if there's something that can be done, it can be done. There has to be an understanding that sometimes the appraiser's right, and sometimes there just isn't data available, and you're not going to get a change in the appraised value of the property. That's just the reality. But if there is any hope for that to happen, we try to make it as reasonable and as painless as possible to enable that to take place. So part of it is just, the same old things with anybody, being respectful, kind, recognizing that they're professionals. Somebody sent an ROV that I read yesterday. It was the nicest thing I've ever seen somebody write. This agent put in there, she was so respectful, and she said, I know you worked really hard and I really appreciate the work you've done. I would just ask you if you could please take a look at this comp and tell me see if there's anything here that can be done. It was really good, and she got her value up, but she did a phenomenal job of being respectful and not trying to diss the appraiser. You'd be amazed how people will write in there all kinds of, cussing the appraiser out, calling them idiots, saying they're stupid. How can they do this? And you're not going to get any traction with that kind of an approach.
Not what you say, how you say it, right?
Yeah, absolutely. Another thing is now the new regulations have just come out from the GSEs that they're allowing 5 comparable sales to be provided to appraisers. I still wouldn't recommend that because sometimes you just bog them down. It's better to have 3 really good ones or 2 really good ones than 5 where 3 of them are mediocre. Your goal is to try to find sales that are within the ranges that the appraiser already used in their report that are going to indicate that the value could be higher or should be higher. And a lot of times you can do that because a lot of appraisers do move toward the lower end of the value range. So you can provide a couple of comparable sales that are at a little bit the higher end of the value range that can sometimes push the needle up a little bit. So it's very realistic to get, to get positive results, but it does take the right kind of data to be presented to the appraiser and the recognition that sometimes it's just not going to work. There just isn't data out there. We've seen a lot of comps sent over in ROVs that just really don't make any difference and aren't going to make any difference. So this is already something we discussed, that you want to stay within the boundaries the appraiser used. The appraiser uses sales that are all within closed in the last 8 months, then you want to try to find something within 8 months. Now, if the appraiser went out no further than a mile, and you got a comp that's a mile, just slightly over a mile, that's fine because that's still close within the range of what the appraiser used. But going out 2 miles when the appraiser kept all their comps within a mile, it just isn't going to work. So there's no point in doing that. And again, we want to use properties that are going to support the value estimate. I can't tell you how many times we get an ROV, and if I send it to the appraiser, it would just drive the value down because all the comps that the person provided are lower than the ones the appraiser used. So that's not helpful if you're looking to get the value to go up. These are just things that go into the reconsideration of value information. Tidewater, I'm just going to quickly touch on that. Tidewater is something that we've initiated as an AMC. It's a requirement of all VA appraisals. So in a VA appraisal that you have done, if the appraiser determines that the value of the subject property is not going to come in at the sale price, it's going to be below the sale price, they are required to reach out to the point of contact, give them 48 hours to present them with additional data for them to analyze to determine, before they submit an appraisal that's going to be under a sale price. So we've initiated that for all of our appraisers. All of our appraisers are required to do the same thing. If the value is going to come under sale price, we ask them to reach out to the point of contact to let them know that they are required to do this and that they're simply asking the agent to provide them with their pricing strategy for the home and any comparable data they may have that might support the sale price. And then they will, they'll take a look at that data before they submit the report. So that's been helpful. It's prevented some ROVs from happening. Some appraisers have told me that once they've reached out and gotten information from the point of contact, they've actually been able to get closer to or reach the sale price when they, because of the comparable data they received was helpful. So it's actually worked out to be, excellent tool. And then quickly, I want to touch on the Pocket Comp tool, value tools. So pocketappraisal.com is something that as Kairos makes available to any of you. If you want to use that, you can go to pocketappraisal.com and you can, there's a comp tool there, because a lot of loan officers really struggle with how to find comps, especially on a refinance where you're not dealing with an agent and you have to determine is there anything I can do to get this value up because the value is down too low. You can go to Pocket Appraisal and you can look at the subject property and you can target comparable data toward that subject property and put together some information that may be helpful in being able to go back to the appraiser with an ROV.
Yeah, I
And
know
then
we're
also
over
pushing-
about a minute. I want to be respectful. People need to get
Yep.
off. I totally understand this is being recorded, so anything you might miss from this point on, this will get sent out to you before the end of the day tomorrow. Go ahead, Gerry. Sorry.
Great. Okay, yeah, and you can also contact Christine or Alex at kairosappraisal.com for any other information that you need.
Well, yeah, thank
That's
you,
it.
Gerry. Hey guys, this was probably almost more informative for me than maybe some of our audience, but I do want to thank Gerry and Alex and Kairos for joining us here and hopefully making a difference in a lot of people's information. So Ben, anything else in closing?
No, guys, I appreciate everyone attending. I'm sorry I was a little quiet on the call. I was the chat box. Everybody had a lot of great questions. Hopefully, I got to almost all of them. There are a couple out there that Gerry that were actually specific for you. We'll get those questions to you, and we'll put you in contact, with those guys individually. But yes, it was actually great. A lot of people appreciated the information.
Yeah.
It's obviously a big part of our business that I think every LO should want to have more knowledge of, be able to troubleshoot and know where to take their avenue on issues, either quality or value or everything along that line. So we appreciate everyone's time.
Yeah, Gerry, anything else to add at all, or?
No, I think we pretty much covered everything.
Alex?
Just thanks for having us. We love working with Angel Oak. You guys really are just amazing. Christine used to be an AE for Angel Oak, so we've, it's near and dear to our heart. It's kind of in our family, we feel like now. And we'd be happy to earn anybody's business and help out any way we can too. There's my sales pitch for this. We do have a 4.9 star average Google review. So you're in good hands with Kairos. Thanks again for your time, guys.
Yeah,
thank you.
Thanks, Alex. Just a shameless plug here. Next week, we're doing a deep dive into bank statements on, I believe, May 16th, the same time. So we appreciate everyone here. Thank you. For those, again, happy Mother's Day this coming Sunday. So appreciate you. For those of you who've closed loans with Angel Oak, we really appreciate your business. And for those who have not, please give us a shot. Have a great rest of the month of May, and look forward to seeing you guys next week. Thanks, guys.
Thank you much.
See ya, guys.
Nice job, Gerry.